Hello and welcome back to today's personal finance show here on Dublin City FM with me, Paul Merriman from Ask Paul, and I'm joined in the studio by none other than the man, the legend in the CFP world, that is Marc Westlake. Marc, welcome to the studio.
Thanks, Paul. Pleasure to be here.
So guys, I kind of give a bit of context to that introduction. So Marc, we have been recently acquired Marc's business, Everlake, which is based in Dunleary. Marc's now operating as Fairstone Dunleary with his business, which is quite exciting for me. And it genuinely is, because many moons ago, myself and Marc sat in UCD doing the CFP, or the grad dip course, together. That was 2009 to 2010.
About that, yeah.
Yeah, so over 15 years ago. And we were the first certified financial planners in Ireland.
That's right.
But you came to that course with already a qualification, which is a chartered financial plan destination from the UK.
Yeah, it's funny. I actually applied for an exemption from the Irish course, and I didn't get one. They said you're gonna have to pay all the money and sit all the exams, because I'd actually miscalculated. So I ended up having to sit through. But look, it was good. It was interesting, and as you say, we were the first graduates of that course, and there are hundreds and hundreds of certified financial planners now. So it's great.
And the reason I gave you that introduction is that I do remember sitting in the class, honestly saying this guy is so far ahead. Because at the time I was coming from Irish Life, and the role was very much a pension salesperson, if I'm honest. There was no financial planning. There was, it was a different world back then in Ireland when it came to advice. I'm glad to say over 15 years it's completely transformed in most businesses. But I do remember you having a higher level of knowledge, because you'd been in the UK, working in the UK. Obviously, had gone through what's called RDR from what was basically a commissions ban, and then what would have been life and pensions business became really professional practices on the back of it. And when we did the acquisition with you guys, I think I put up on our Instagram story that you were probably one of the best financial planners in the country that I've come across. And I always use a test when we're looking at the partner with firms and bring them in. And that test is, would I send my parents to that person? And I think in this case, not only would I send your parents, but when we were selling the business 3 years ago, if I was to pick any CFP in the whole country to sit down with, it would probably only be you. From that level of knowledge, from tax and just everything being so broad. So, and I think from listeners' point of view, the reason Marc has come on, I suppose, is to help us with Fairstone and that kind of bespoke financial planning piece. So I do genuinely mean this. It's a pleasure to finally be in business together after sitting in class 15 years ago. Yeah. And I am excited about the future. But Marc, why don't you bring listeners through what you do? And let's not turn it into a whole bugbear exercise with the industry, but let's have a chat about what you do that's been so different and what you're passionate about.
That's a great question. Yeah, I mean, as you say, I used to work in a high street bank. I mean, we've all come from very much similar backgrounds. Everybody that I know in financial advice that's spent any time has started with a very similar background, which has always been, you learn the trade, and as you said, it's a financial services industry, and many of us, like yourself included, have tried to expand the amount of advice that we're able to provide, so scaling up across the country. And the second thing we've always tried to do is professionalize. So, one of the things I did was I helped set up the Society of Financial Planners in Ireland, because there wasn't a representative body for those CFP graduates to actually sort of go and commingle and spend time with each other and do peer learning. The best way to learn is from other people. So, I've been quite a strong advocate and consumer advocate for improving professional standards in Ireland. We've some way to go still, but it is improving all the time. And you can see some of the best practices, and it's not just from the UK. You see people going off to the US recently. I'm just back from South Africa. There's lots to be learned from other professions as well. So I spend a lot of time talking to lawyers and accountants, and it's just trying to make sure that ultimately the prize here is getting better advice for end consumers. So that's my passion. I
think that the role of the financial planner, I think you've done this really well in your practice, and like I said, hope and take the learnings into ours, is that I think the financial planner's role now, or I find necessary when we're talking to business owners, particularly people that have maybe larger estates or kind of particular financial planning niche needs, that you end up kind of being a chairman. You end up being like a financial coach. You get into behavioural pieces. You get into, you do end up touching on tax and legal more so than I think everyone thinks it's just about a pension or investment. And more often than not, you can get pension or investment advice kind of anywhere. And everyone's going to pretty much have same funds and same returns. It's more about that bespoke relationship and being able to call in the right people at the right time to aid that plan, isn't it really? Which is back to that legal and tax piece.
It is, yeah. I mean, personal finance, I always say, is more personal than it is finance. I mean, every one of us can use a spreadsheet. So our starting point in terms of, as you say, the availability of different products is the same for everybody, but it's that personal touch. Yeah. So, I always say, you don't go to a Harley Street brain surgeon for a box of aspirin, right? But you do if you've got a brain tumor. So, once you get to a certain level of complexity and a certain level of wealth, I think there is a need to actually take a step back and think, well, can I do this on my own? And a lot of my clients will be very, very competent professionals. A lot of them will be accountants and solicitors. They could do it themselves, but they get to a point where they just don't want to take that risk anymore. And they also recognize that the one vulnerability they have is they're not immortal. And they don't want to leave a mess if anything happens to them. So that's, I think, where the role of a really competent kind of wealth manager, kind of financial planner comes in, is to be able to say, look, we can help you with some objectivity. The one thing I can't be is objective about my own finances. So I'm happy to employ a financial advisor myself because I'm not going to be here forever, So those sorts of things all come around to the end result of, it is important that you get good advice, but it is also important that you're working with somebody that cares and actually takes an interest in why the money's important to you rather than just how much you've got.
Yeah, we mentioned the spreadsheet there. I was doing a corporate talk at a pharmaceutical company during the week, and there was a few hundred people in the audience, and I remember looking into the audience, and I could see they were kind of, not even before I started, but just kind of, this was another talk. And I remember starting off with the spreadsheet. So I always say to people, when it comes to a spreadsheet, we can all put figures into a spreadsheet, and the spreadsheet will give you the answer that's obvious. So let's use the example of a 20-year-old putting money into a pension plan versus a 30-year-old starting 10 years later. Obvious the 20-year-old is going to have more. It's obvious, and the spreadsheet can tell you. But the spreadsheet doesn't know the 20-year-old's goals, ambitions, their health, are they part-time, are they full-time, do they want to travel the world, are they living in gig economy, or are they a professional? So there's so many things to know, and I think this is where the financial planner's role really kicks in. It's getting to know clients and hopes and goals, aspirations, kids, everything that really makes up the DNA of a good financial plan.
Yeah, I think you're right. I mean, if you distill it to one question, I mean, I'm using a lot of AI at the moment. I use ChatGPT a lot, and I asked the question, could you replace me in terms of my knowledge? And it said, yeah, absolutely. I mean, a lot of this is freely available on the internet, and anybody can use a computer to find out the answer to a simple question. And I said, well, what's the one thing you can't do that I can do? And it genuinely said, I can't put my arm around a grieving widow. I thought, well, that's the personal touch. You can't make that in a spreadsheet. So
actually, a client came into me. It was the first experience I've had of this, where the client came in with a ChatGPT answer to the question he wanted to ask me. But it got one thing wrong. So he was trying to get X amount of money, and for a reason to buy a property. And he put in all the assets and all the usual stuff into it. And he just done a course that goes in UCD in relation to it. So he used ChatGPT, and it came back with pretty much what I would have advised. Honestly, not too far off what advice. Yeah. But ChatGPT didn't realise that the car they were asking him to sell as his assets, that he built it with his brother, who'd passed away.
Right.
So he wasn't going to sell the car. Now, okay, he could have probably went back and tweaked it himself and told I can't sell the car, or I don't want to sell the car. But it just, there's no personality with it, and they don't know the real understanding. Back to the spreadsheet thing.
It's garbage in, garbage out. Yeah, AI is perfect in the right hands. It's absolutely fatal in the wrong hands. If you ask the wrong question, it's definitely going to give you the wrong answer. Because you're not going to know you asked the wrong question. Yeah.
I was at a conference in the UK last week. The CISI held the Financial Planning Awards, and I was actually flying back from Heathrow the next morning. So I went to the dinner that evening, and AI came up at the table. Say another 10 odd financial planners, and yeah, it was interesting. Some people were saying it's not going to make any impact whatsoever. Some people are thinking it's the end of their careers. I think one person kind of really nailed it, saying it's going to enhance our career. It's going to make it easier for us to do certain things and let us spend more times with our clients and more time in those meetings. So rather than having maybe a 40 or 45 minute meeting and then having to go off and spend 45 minutes on paperwork and compliance issues, that can all be done in 5 minutes, which now gives you maybe an hour and a half and getting to know your client more. So hopefully that's what happens with AI, and because I'm going to embrace it, and I think it's great, but I can't see it replacing the actual relationship that people have with financial planners. But if you're just making a pension contribution, through a bank or through your payroll and you don't care, technically speaking, it's going to give you the right answer of what you need. I mentioned the word bank. Let's have a chat about 160 odd billion that's sitting on deposits. What's your I think everyone that listens to my show knows my thoughts on it. But obviously you have come across this with clients, no doubt, when people sitting on cash or in government bonds or state savings, etc. So what do you think?
I remember Charlie Weston a number of years ago asked me for a headline on prize bonds, and I said, you're twice as likely to be struck by lightning as you are to, at the time it was €1 million prize. I think you need to sort of put this into some context that resonates with people. Collectively as a country, we lose about €1 billion every month in opportunity cost or lost interest on that 165 billion. If we all collectively just decided one day to just put that money to work in capital markets, so the stock market, the average return for a euro investor since 1970 has been about 8% per annum. We're earning less than 1%. So that differential it's €1 billion a month. We're losing 12 billion a year. That's €200 per household per month that we could get back in productive capital. So I'm not suggesting that we all take all the cash, because cash has a role to play and everybody should have some money in the bank. But there's money just rotting. It's just unproductive. There's loads of things we could do. There's homelessness. There's we've shortage of houses. A metro up to Dublin Airport. There's just a couple of things that I've got specific bugbears about. It'd be nice if some of that money was deployed to actually making a difference, rather than just going down by 1.5% a year because of inflation. So that's a problem.
You mentioned something there about you're right. So we're saying it's $1 billion. Okay, not everyone's going to invest or want to invest. Let's say we take a bit of that, but that £200 a month, or that funds the children's education. It pays off your mortgage. I did actually that talk I did during the week. I remember the figures. It was a €300,000 mortgage, 3.8% interest rate over 28 years, and the cost of capital. This will be good now if I pull this off. Where the cost of interest was €187,000 to the bank. So 28-year mortgage, 300k. At 3.8%, and the repayment was $1,422. If you're gonna I haven't got my screen on, so if you're gonna watch this on YouTube, I do remember this. But when we put in an extra payment of €200 a month, it saved 40 grand and reduced the term by over 5 years. So people think financial planning is about, and I know you particularly deal with really high net worth and the higher end of the marketplace, but it can be £50 a week. That can change your life. And it can be that £200 a month. I remember doing an ABC calculation for the same presentation, 250 a month invested since from 1990 to 2023, so a 32 or 33 year period. £250 a month into an ABC gives at 9% return, gave a €609,000 pot. So again, the 250 is gross. After tax is about 160, 170. So again, £50 a week can just either pay someone's mortgage off, if you've got a 20-year term 5 years earlier, or if you're going into a company pension plan in your 30s. It can give you an extra 600 grand. It's just phenomenal. That chipping away. So
it is, and financial literacy is not really taught in school still. So you come out. I mean, my 16-year-old's just done his junior cert, and he's not going to be prepared to do simple budgeting. He's not going to be prepared to actually think about, if I take 5 or 10% of my salary before all the direct debits kind of go out over the beginning of the month. If I move that money aside into a separate account, that's just that mental accounting, just moving that money around and saying, that's my money. What's left over is for the bank to take and pay all my direct debits. That discipline makes all the difference. It's so hard to get it into that habit if you're in your 40s and you've got kids and mortgages and stuff to pay. So just starting early and just very, very small incremental habitual benefits, huge.
It is back to those habits and starting those habits as young as possible. I mentioned the budget earlier on before you came into the studio on the first part of the show today. Just if anyone's missed that, head over to the Spotify and search for Ask Paul on Dublin City FM. You'll pick up the first section too, as well as all the other shows. But Mark, let's talk about the big thing probably for our industry in the budget. Outside of the 1.5 million entrepreneurial relief, that's great for clients that are business owners and people selling businesses, to be fair, like us. But let's talk about the 38% exit tax. So, we talked about financial literacy. If you look at what's happening with the European Union, they're trying to harmonise tax. I think the EU has really woken up to the fact that citizens in the EU just don't invest, and they are those savers that are just kind of losing wealth and money. So typically speaking, every decade that goes by without having people invest, that the citizens are less wealthy. So they're starting to wake up. I think there's massive pressure on Pascal to bring their tax down towards 33%. But he was never going to give it away in the first budget of a new term.
No.
So are you like me thinking this is going towards 33% over the next 3 years, and before the next election you get it to 33?
Yeah, well,
with CGT?
One of my favourite phrases is never make forecasts, especially about the future.
And revenue and tax
and revenue
and
tax.
Irish.
Don't ever try and apply any logic. I mean, the real problem with the taxation of investments in Ireland isn't the rate, it's the complexity. So, you know, I've spent the last couple of years, I remember when the rate of tax went from the 33, 36 up to 41, it was over a decade ago now. And we actually proactively got all of our clients to sell all of their investments before the end of the year to lock in at the lower tax rate. And we jumped ship. We actually jumped onto a different horse altogether, and we said, this fund taxation, it's for the birds. It absolutely makes no sense at all. And we fought tooth and nail to get all of our clients into what's called general tax principles. So that CGT rate of 33, it's really hard to do, and it's unnecessarily difficult. And I remember asking a question from some lawyers. I said, well, you know, surely there's something in the Constitution about fairness and equity. And there's a get out of jail free card on tax, which is as long as everybody's treated the same, even if the outcome is bonkers, it doesn't matter. It doesn't need to be fair. Tax doesn't need to be fair, reasonable, or equitable. It just needs to be that everybody's treated the same. And we're all treated really poorly by the current tax regime.
Yeah.
And that's just wrong.
You're right, Mark. It is wrong. And I mean, if you look at the amount of tax everyone's paying, you know, and the high rate of income tax as well, by trying to take that money out, it's being taxed to the hilt, and then you're investing it and it's getting taxed. And massively unfairly. I mean, even if exit tax on investment products or the life industry is, and ETFs is coming in at 41% exit tax, even bring it down to 38%. The deemed disposal is still so impure. Like, we're the laughing stock of the world. Like, I remember seeing an American content creator talking about how the Irish government make you dispose of your assets without you wanting to, and tax them as if you disposed.
Yeah.
Like, it's the most ridiculous, comical
It's
kind of tax you come up with.
It's completely undemocratic as well, because if you look at income tax is actually very progressive. Most people don't pay the headline rate 52. You need to be earning more than 200,000 a year to be paying a very, very high rate of tax. And in order to be paying that 38% tax rate, you need to be earning, from an average rate of tax now, you need to be earning about 180,000 a year for your average income tax rate to come up to 38%. Now, if you're retired and you're on a pension and somebody's saying you're paying 38% tax, that's ridiculously punitive.
Yeah.
It's not right.
Yeah, it's not, and especially because it's, you know, I keep going out. There's your after tax income, whatever goes your gross income from a salary or a pension being taxed. But yeah, paying tax and then getting taxed on the growth of something after you put money, it's the same. And you mentioned like that 38% or is 180 grand salary. Like, take it that even somebody that's maybe a part-time worker has a child and they're recycling the children's allowance in for an educational fund. They're getting taxed the same as somebody on their income at 180 grand is. Even though it might be only maybe 20, 30 grand a year.
Yeah.
And they're trying to do something good to put their kids through education or to hand it down to the kids to get the deposit, whatever it is.
Yeah.
It's no one's business really what they're doing it for. But yeah, they're getting taxed like a 180 grand salary will be getting taxed, which is mental.
And look, I love to play cat and mouse with this stuff. So the two things that we've been doing a lot recently. The first one is, you know, if you get hit with a 5,000 income, a passive income from rental income or dividend income, revenue get you, and they say, we're going to make you pay a little bit of PRSI here. So you pay your social security. Now, the way they've done it, it's class S, which is contributory state pension. So we actually situations where we'll have somebody who's maybe a non-working spouse. The children are over 12, so they're no longer getting their automatic credits put on for home responsibilities. If we can artificially create a situation where there's a €5,000 income coming into the household, that's going to give you contributory state pension credits. You're going to get that money back in spades in your 60s. So that's one way of doing it. And the other one is the earned income tax credit, which is $2,000 a year. If you've got more than $10,000 in income coming into the household from earnings, you get a $2,000 tax credit. If you don't, you don't get it. So we have a lot of clients where they take their pension income early in order to get that tax credit. It sounds counterproductive, but you're playing cat and mouse with revenue all the time, where you're thinking, they're taking all this money off of me on the left hand. I'm going to try and get some of it back with my right hand. So that's, again, good competent financial planning is now becoming, as I always say, you know, investing is not difficult. You can Google how to invest your money. Everyone in Ireland has a tax problem.
Yeah.
And that's where good financial planners are really earning their keep now.
Yeah, I think, you know, one thing to keep in mind there is that you have a tax problem now while you're alive and you're making money and your investments are growing. You know, I think you said this before, that the more wealth you create, the bigger your tax problem gets as well, because you then have the succession planning to go.
Yeah, it's a good point. I mean, you know, like I always say, look, I'm going to solve one problem, which is make your money work harder, and I'm going to create another one, which is if you've got 2 kids, you've just got another one called revenue. They're going to take a third of everything we make. So if we make that money in the wrong hands, shall we call it, revenue are just going to help themselves in the long run anyway. So how you invest the money is one thing, but where you invest the money is another thing. But then even who owns it.
Yeah, the structure around it, so likes of trusts, or so again, this is where I'm not saying ChatGPT won't be able to tell you this stuff, but it just does become complex, because every nearly situation you put yourself in financially, you have to think about the long-term issue for the client. I think that's where, I know we're kind of going to, not blowing trumpets here, but we've obviously been CFP'd for 15 years. You've been longer than me from the UK point of view, but it's that experience really with clients, and being around the tax advisors, the legal guys for so long, that you end up developing that longevity issue as well. So when you're creating something for the client, it's not about just solving, I need to invest today. It's about what happens in 10, 15, 20 years time. Actually, the client in before you came to the office today, and we were talking about the family home. The family residence worth about 1.3 million, and they're exceptionally well funded pension wise and investment wise. 2 children, so the children have an 800,000 limit on the CAT from a revenue threshold point of view. So it's like transfer it into the kids' names now, get a little bit of write down, because you can get to live in the residence till the day you die. I think the tax might work out about maybe 50 to 60k now, but if we just grow the property at 4% over the next 30 odd years, that comes up to a 3 million property. And now, okay, you might say the thresholds will increase over time, but they're still, but they might do. But even if they said he went from to 1.6, they're still looking at 800 grand liability. So it's really trying to foresee. And they just came in for a bit of pension advice. But you gotta, there's the pension advice. But with 2 children and a 1.3 million residents, here's your next problem. And make sure we're covering this off by just literally very simple planning. But I think that's what we're there for, and it is crucial for clients to think that way.
I think there's a point to make there as well, which is you need to make the distinction between what I call parenting and the bank of mum and dad, right? So I hear people all the time saying, "Oh, we're going to use the 3,000 small gift exemption to put money away for school fees or for your college," and I think, well, that's exempt anyway.
That's exempt.
Revenue will let you do that.
Just keep that in. You don't use that. No.
If the children are under 25 in full-time education, as long as the expenses are reasonable, and they don't define reasonable, but you can figure it out. That's parenting, and that's not a gift, and it doesn't come off the exemptions. If you're buying them a house or a house deposit, then that is
gifting,
and that needs to be. That's where the $3,000 exemption. Not on college. So
we do get clients asking, what do we use, a bear trust or a trust rather for the kids, for the college? Absolutely not. That's the money you want to give them when they're 30 or 40 when they're trying to get a house together, because it really saves you against the CAT. Mark, talk a little bit more about, from like, we do a lot of succession planning for our clients, whether we're using Section 72 whole life products to make sure the liability is looked after from that point of view with life policy, or whether we're transferring assets now or using a small gift exemption. But from your practice point of view, any major complexities, or is it all like it just gets bigger? But it's the same solutions really, isn't it? It's just bigger, a little bit more complex. Maybe people going non-dom, maybe down to Portugal, they can't do that anymore as well. It's not as easy. Or Dubai, or are you seeing much of that with your clients thinking? Because I don't know, a lot of people said when we were selling our business, like, you're getting hammered on CGT, and if you went here, you did this. I personally think I don't mind paying the CGT. I've built the business in Ireland. It's been very good to us. But I do know a lot of people that do move abroad. Nothing wrong with it, by the way. But I don't like the not being able to come home when I want to come home, and not having the freedom and trying to, not say hide from revenue, but checking if you're in the country X amount of days and all that nonsense. Do you see that much with your clients? Because you'd have a higher end client probably than we would in that sense.
Yeah, that's a really good question. I mean, I used to advise lottery winners in the UK, and the UK lottery has a very paternalistic view. If you win more than £500,000, you're automatically put in front of somebody like me and a solicitor and an accountant. And I asked what the tender process was for the panel of advisors for the Irish lottery, and there isn't one. It just doesn't exist. You could win 100 million on the Euro Millions, and you're just left on your own.
They give it to you,
and it's quite scary. So I think it's what we call sudden wealth. If you're a business person and you've been working for 30, 40 years in your business, you've been working with lawyers and accountants your whole life. You've probably become more familiar with the issues, and you've spent time thinking about it. If something's just happened, if you've inherited the money, you've won it on the lottery, you don't get time to prepare for it, and I think that makes it much harder for people. So that's the first point. But in terms of complexity, I mean, sometimes the simplest thing to do is to just spend the money. I mean, I'm a big fan of the phrase, there's no prizes for being the richest person in the graveyard.
100% agree.
We tie ourselves up in knots trying to save the last penny in tax. And actually the best question is sometimes to ask very simple things like, what's important about money to you? And people very rarely say more. All right. The finite resource that we all have is time. It's not money. So you really want to think about what is it you're actually trying to do here? Are you looking to help your children, into the world? We call them boomerangs now. You send them off into the world, they keep coming back. The joke I use in conferences is they should make a millennial version of Monopoly where the kids just go around the board just renting, but never actually owning anything, because that prepares them for modern life in Dublin. And we all laugh, and it's like, I'm not joking, that's true. I've got 2 kids. I don't know how I'm going to get them out of the house.
Yeah.
So that sort of thinking and planning is really about what is it you're trying to achieve as a family, not, can I save the tax down to the last penny? And it is really important that you start with, I always use the phrase, whilst I'm a financial planner, I don't think any one of us has a financial goal. There's no prizes for being the richest person in the graveyard. We have lifestyle goals. How do we want to live? Where do we want to live? And that have financial implications. How am I going to pay for that? So yes, you could move to the UK. I mean, my xenophobic former countrymen and their inability to get on with the rest of Europe, as a result of Brexit's become the favourite tax haven now for Irish people. You leave the country for 3 years, Irish revenue, lose interest in your capital gains tax. You're not subject to UK tax unless you've been living in the UK for 4 years. So there's a window of 12 months where you can just not have to pay any tax in either jurisdiction. And Bob's married to your Auntie Sue. Very, very simple planning, but it means you've got to live in the UK for 4 years. I've done that for half of my life. I don't want to go back.
Yeah, that's a really good example, actually, that year gap. Yeah, it is a good example. But some people will want it and some people will take advantage of it. But look, you just said the most interesting thing there, what's important about money to you. And like I said, I don't think I've ever heard a client saying more. No. Yeah, they usually get into their kids, usually get the spending, they used to get the holidays. Like I get people to talk, when we're doing the kind of financial wellness we do for employers, when we do them for those talks, we always say to people, like, just take 3 or 4 minutes here and write down your financial goals. And the biggest financial goals I kind of see people, they think is retire early, but it's not. They don't want to work because they want to spend more time traveling, or they want to do something, spend more time with kids, or, it's not about not going to work. And you're trying to get people to think about that. And the same when I say about goals, the biggest goal I kind of find at the moment is probably, maybe getting on the property ladder, or people moving houses. That's a goal, to be fair. But yeah, other than that, you're right. It's just down to what type of lifestyle you want to live and how are you going to live it.
Yeah, and we've always couched that in things like, when you get on a plane, do you turn left or right? But that's consumption, that's discretionary spending. And I think you're right. I think it's where you live and how you live are much more important to more and more people. And it's a lovely first world problem. I mean, Ireland's a lot wealthier now than it has been for a number of decades. So the problem that we have kind of as a society is there's no kind of history of, first, second, third level generation wealth here.
Yeah.
Where are you going to pick this up? Unless we as a profession get better at helping people work through all these issues, you can't go to your parents and say, well, what did you do? Well, nothing. We had 7 children and there was so much to go around.
Yeah.
So it doesn't work. We have to make this up now from scratch as we go along. And that comes back to my earlier point about the money that's on deposit. What kind of society do you want to live in? It's not just about, am I all right, Jack? It's actually, what kind of, society do we want to live in? And I make the point about the UK, and the US to an extent. These are political issues, but they're also social issues, but they're also financial issues. And as a household, we can choose all of those in terms of what our preferences are. I think that's an important kind of sort of social element to this.
Mark, you know what? I think we'll leave it there on that note, because I think that's a really, really nice way to finish a discussion on financial planning. And although we started talking about that higher end client, everything you've spoke about is true to every client. It's true to nearly every citizen, regardless of what level of income you have. And I think what's good about this conversation for me is that it's not about trying to pitch over radio, or, when this gets watched back on YouTube or on Spotify, it's not about trying to pitch, we only look after clients that have 10 million or 5 billion or 3 million or whatever it is. It's just that you can't help talk about the natural benefits of financial planning.
Exactly.
And it doesn't make a difference whether it's 200 quid or whether it's 20 million, or it's back down to what's important about money to you and what are those lifestyle goals, which I think is really, really nice to hear.